Trusts hit the top 37 tax rate after just $15,650 of income, while individuals don't hit that same bracket until over $600,000. That means your trust could be paying the highest rate in America on a small amount of income, and you might not even know it. Here's what makes this so confusing. Sometimes you pay the tax, sometimes your beneficiaries do, and sometimes the trust itself pays, even if nobody takes a dollar out. In this video, I'll show you exactly who pays when, how to use trust distributions to legally reduce your family's total tax bill, and how to make sure your financial, tax, and legal planning work together so more money ends up with your loved ones, not the IRS. Let's dive in. Here's what commonly happens. A parent passes away and leaves a trust for their kids. The trust earns $80,000 in dividends and interest. The trustee distributes $30,000 and keeps $50,000 to be safe. That $50,000 is now taxed inside the trust, which hits the top 37 bracket. Add the 3.8 net investment income tax, and you've just burned roughly $18,000 in avoidable taxes. Now imagine instead that the trustee distributed the full $80,000 equally to 3 adult kids, each in the 24% bracket. They would collectively pay around $19,000 instead of the trust paying $31,000. That's a $12,000 difference every year. Over 10 years, that's $120,000 left for the family instead of the IRS. Here's the point. Distributions aren't just about generosity. They are a tax tool. When structured properly, you can shift income to beneficiaries in lower brackets, reduce overall tax, and preserve more of your legacy. That's the first big mistake. Before we go further, quick note. I'm a fiduciary financial advisor, not an attorney. This video is for education only, to help you coordinate the financial side of your estate with your CPA and attorney, so everything works together smoothly. If your trust is revocable, your standard living trust, taxes are simple. Think of it like a clear box. The IRS looks right through it. Let's say your $2 million revocable trust earns $60,000 in dividends and interest. That income is reported on your personal return. Whether you take $10,000 or $100,000 out to your checking account doesn't create new tax. You are just shifting your own money from one pocket to another. So why this matters? Many people expect trust tax savings during life from a revocable trust. That's not how it works. Revocable trusts are great for avoiding probate and keeping things private, but they don't save you taxes while you're alive. Here's what you need to verify. All your accounts are titled properly and beneficiaries across IRAs, life insurance, and transfer on death and payable on death designations match your plan. Most people get the trust drafted but never coordinate the accounts. That's where families lose money, and that's exactly the coordination work we do with clients. Okay, the transparent box is easy. The interesting planning starts when the box isn't transparent anymore. Some irrevocable trusts are intentionally designed so you, the grantor, still pay the income taxes even though the assets are no longer yours. Sounds strange, right? But it's a powerful wealth transfer tool. Here's why. Every year you pay the taxes from your own pocket. Your trust gets to keep and reinvest all the income, essentially giving your heirs a tax-free gift. It's like paying the trust's grocery bill so the trust can keep investing its cash. What makes it a grantor trust? Things like the ability to swap assets of equal value in and out, use trust income to pay life insurance premiums, or add charitable beneficiaries. If the trust has any of these powers, the IRS generally treats you as the tax owner. And that's exactly what we want for this strategy. Let's say your irrevocable grantor trust holds $3 million of investments for your kids. The trust earns around $90,000 a year in dividends and interest. Because it's a grantor trust, you pay the taxes on that income personally, maybe about $25,000 a year instead of the trust paying it. Over 10 years, that's roughly $250,000 of taxes you've covered from your own pocket. Here's the powerful part. By doing that, you've effectively made an extra $250,000 gift to your children, without filing a gift tax return, without using your lifetime exemption, and without reducing your estate tax limit. You're paying the tax now, so your trust can grow faster for them. It's one of the few truly tax-free gifts the IRS allows. That's the grantor-style planning. But what if the trust really is its own taxpayer? Then the rules around distributions do the heavy lifting. When a trust is a true non-grantor trust, it becomes its own taxpayer. That's where the term DNI comes in, distributable net income. Trusts can often push the tax bill to the people who receive the income. Think of it like this. The trust has a bucket of taxable income. When the trustee pours money out of that bucket to beneficiaries, the tax bill pours out with it. But if the trustee keeps the money in the bucket, the trust pays the tax itself. at those brutal compressed rates. The bucket doesn't care who pays the tax. It only cares whether the money stayed or left. Let's say your trust earns $120,000 in income this year. If the trustee distributes $90,000 to your kids, the total tax across the family might be around $31,000. But if the trust keeps all the income, it could owe roughly $46,000 in taxes. That's about $15,000 more, just because of how quickly trusts hit the top 37 bracket plus surtax. Why this matters? Distribution timing doesn't just affect the trust tax. It can also push retirees into higher Medicare IRMA brackets, increasing premiums for an entire year. So here's what to do. Each fall, sit down with your advisor and ask for a projection. If you distribute $90,000, what's the total family tax? If you retain it, what does it cost? What happens to IRMA? Make the call based on data, not guesswork. That's the regular trust income. Now let's talk about retirement accounts. Because when your trust owns an IRA, timing can save or cost families six figures. If your IRA or 401k lists a trust as beneficiary, there are two common patterns in plain terms. A conduit setup where required withdrawals from the IRA flow straight out to beneficiaries each year. Simple, cleaner taxes, less control. An accumulation setup where the trustee can hold some or all of the IRA withdrawals inside the trust. More control, better protection. But now you're back to those compressed trust brackets. Let's say you name an accumulation trust as beneficiary of a 1.2 million IRA. Under the 10-year payout rule, the account must be emptied within 10 years. If the trustee waits until year 10 to withdraw it all, that's a 1.2 million distribution taxed at top rates, maybe $400,000 in tax gone in one shot. A smarter plan is to map a 10-year stair step. For example, $70,000 in years 1 through 8, then $100,000 in years 9 and 10, while checking the trust document, your heirs' brackets, and state taxes. The trust still protects, but you've traded default for design. If you've named the trust as your IRA beneficiary, work with your advisor to model that 10-year timeline. It's not just a legal decision, it's a financial coordination issue. So that's income. What about capital gains, like selling a home that sits in a trust? I've got some good news. If your home is owned by a Revocable or Grantor style trust, you still get to use the home sale exclusion, up to $250,000 for individuals or $500,000 for couple when you sell your primary residence. This is called the Section 121 exclusion. Here's a simple scenario. Your home is in your Revocable trust. You've lived there 15 years and sell it for a $400,000 gain. Because you are still treated as the owner for tax purposes, that gain is tax-free. Now here's where people get burned. If the house is in a non-grantor irrevocable trust and the trust sells it, the exclusion is lost. That same $400,000 gain could create a $100,000 plus tax bill. Think of Section 121 like a boarding pass. The name on the pass has to match the person getting on the plane. If the trust is structured so you are still the owner, you get on the plane. If not, you are stuck at the gate. Before transferring real estate into an irrevocable trust, check with your attorney to confirm whether that exclusion stays intact. Alright, let's bring it all together. This is how you make sure your trust and your taxes are working in sync. Here's a quick checklist to keep more in your family and pay less in tax. Step 1. Identify your trust type. Is it revocable, irrevocable grantor, or irrevocable non-grantor? That's the foundation. Step number 2, decide who should pay the tax. If the trust is a taxpayer, run a side-by-side. Retain all income versus distribute to beneficiaries. Aim to lower the total family tax bill, not just the trust tax. Step 3, plan distributions with numbers. Target a dollar amount for this year. Match it to beneficiaries' brackets and watch IRMA. Revisit each fall. Step 4, coordinate for big moves. If you are selling a house in a trust or naming a trust on an IRA, get the team together first. Attorney for the documents, CPA for reporting, financial advisor for timing and cash flow design. And keep in mind these 4 planning principles. First, right-size distributions to match beneficiary brackets, not just to be conservative. Second, if it's a grantor trust you are paying taxes on, use it for high-income assets like bonds and real estate investment trusts. Let the trust hold the tax drag while it compounds. Third, watch the 3.8% net investment income tax threshold. Distributing income can help both the trust and the beneficiary avoid that surcharge. Fourth, know how your trust treats capital gains. Some documents let you push gains out with distributions, worth exploring with your team. These aren't loopholes. These are strategies built into the tax code. Use them. Simple steps, big dollars over time. If you want help coordinating this, distributions, IRMA, who pays what, and how it all lines up with your retirement income, let's make sure nothing falls through the cracks. Schedule an estate clarity meeting using the link below. We'll discuss your situation and see if coordinated planning is right for you. No pitch, no pressure, just clarity on the next steps. Now that you know who pays when your trust earns income, the next question is, are your accounts even titled properly? Watch this where I'll show you the #1 funding error that costs families tens of thousands.